Hey, are you thinking about buying a home but not sure if now's the right time? Have some coffee. Let's go on this journey together. Mortgage rates, inflation, home prices, they're all over the news. It can feel impossible to know what to do. But here's the truth real strategies can make homeownership affordable in today's market. And in this video, I'm breaking down the latest mortgage rate trends. And by the end, I'm going to give you 3 strategies that can help you find a home today and make it more affordable. Now, before I give you those strategies, first we need to talk about where mortgage rates are right now and where they're headed. A few months ago, many experts predicted rates would fall in the 5% range by the second half of 2025, but that's not the case anymore. According to US News, mortgage rates are expected to stay between 6 and 6.5% for the next 2 years. That's a pretty big adjustment from earlier forecasts, and it means buyers may need to rethink that wait for lower rate strategy. If you are waiting for rates to drop before buying, you might be waiting longer than you thought. And while you wait, home prices are still rising, which means the cost of waiting could outweigh the potential savings of a lower rate later on. So, why the change in expectations? Well, mortgage rates are closely tied to inflation and Federal Reserve policy. And according to the current numbers, inflation has slowed. It's still higher than the 2% Fed target. That alone means interest rates might take a little longer to go down than we thought. And right now, things are pretty unpredictable. So let's look at what major industry experts are forecasting for mortgage rates through the rest of 2025. Right now, a 6.9% is the rate for your 30-year fixed loan. And while U.S. News expects rates to be 6.5% at the end of the year, Fannie Mae, MBA, Wells Fargo, they're all predicting rates to remain in the 6.5 to 6.9% range throughout the year. By fourth quarter of this year, the average projection across all 3 sources is 6.53%. That's well above the 5% average people were hoping for. Looking further ahead, most experts predict they'll stay between 6 and 6.5% for the next 2 years, meaning we probably won't see them drop in that 5% range anytime soon. Key takeaway here: don't wait for that perfect moment when rates magically drop to 5%. You're likely just going to end up paying more for the same house later on. Now that we've covered where mortgage rates are and why waiting might not be the best strategy, let's talk about the 3 strategies that can make homeownership affordable right now. Here's the good news. There are alternative financing strategies that can help lower your monthly payments and make buying a home much more manageable. If you've been holding off on buying because of high mortgage rates, this strategy could save you a ton in the early years of your loan. A mortgage buydown lets you pay upfront. You negotiate that with, with the seller to have him covered, or him and her, in exchange for a lower interest rate now. Here's how it works. A temporary buydown lowers your rate for a set period, typically 2 to 3 years, and the most common is the 2-to-1 buydown. It means in year 1, your rate is 2% lower than the current rate. Year 2, it's 1% lower. And in year 3, you go back to the normal fixed rate. Think of it like an on-ramp to homeownership. It gives you time to adjust to your mortgage while locking in a lower payment up front. And if rates drop in the next couple of years, you can always refinance before your payment goes up. That's strategy number 1, the mortgage buydown. Let's talk about the big scary one, though: adjustable rate mortgages. Yee, that's scary. Now, adjustable rate mortgages, or ARMs as they're most often referred to, have a bit of a reputation. And if you remember the 2008 housing crash, you might be thinking, no effing way am I touching one of those. But today, those ARMs are not the risky loans that they were back then. They start with a lower fixed rate for a set period, usually 5, 7, 10 years. After that, the rate adjusts based on market conditions. Buyers who plan to move or refinance within a few years can take advantage of the lower starting rate and save thousands. Before 2008, banks handed out ARMs like candy without even verifying if buyers could afford the payments when rates went up. That's no longer the case. Lenders now require buyers to qualify for the highest potential rate up front, making these loans much safer. And it turns out more buyers are turning to ARMs to keep their payments affordable. As mortgage rates have gone up, so has the percentage of buyers choosing ARMs, which shows people are looking for more creative ways to navigate today's market. If you know you won't be in your home for the next 30 years, maybe you're just relocating in 5 years, or you plan to upgrade, an ARM could be a smart move. Why pay a higher fixed rate for 30 years when you don't need the house but for a few? The third alternative financing option is the assumable mortgage. Now, that's a key component of a strategy that most buyers don't even know exists, and it could be a game changer. What if instead of getting a new loan at today's 6.5 to 6.9% range, you could take over a seller's existing mortgage at 3%? That's what an assumable mortgage allows you to do. How it works: certain government-backed loans, FHA, VA, USDA, they can be transferred from the seller to the buyer. And instead of applying for a new loan, you take over the seller's current loan terms, including their lower interest rate. If the seller locked in at 3%, that's the rate you get. No need to take your 6.9%. More than 11 million homeowners in America have assumable mortgages. But here's the catch. Not every loan qualifies, and buyers still need to meet the lender requirements. You still need to qualify just like you would for any other mortgage. If you're buying, ask your agent if the seller's loan is assumable. It could mean saving hundreds of dollars per month on your mortgage. And if you're selling, highlighting an assumable mortgage could help you attract more buyers. Now, it's time to bring it all together. While mortgage rates are higher than they were a few years ago, there are real ways to lower your monthly payments and make homeownership more affordable today. Whether it's a rate buy down, an ARM, or an assumable mortgage, buyers have more options than they think. Even if mortgage rates do come down slightly in the next year or two, home prices are expected to keep going up. That means waiting could actually cost you more in the long run because you'll be paying a higher price for the same home. Consider this scenario. Say you're looking at a $400,000 home now with a 6.9% interest rate. If that home price rises just 5% over the next year, that same house would cost you $420,000. Even if mortgage rates drop by 0.5%, you're borrowing more money, meaning your payment might not actually go down at all. The longer you wait, the more risk you're taking getting priced out of the home you really want. Over the last couple of years, buyers have faced crazy bidding wars, selling in days and offers way over asking price. But right now, things are much calmer. There are a few buyers competing. Well, no, there's fewer buyers competing, actually, meaning more negotiating power for you. Sellers are more willing to offer concessions, which can be used for covering closing costs or buying down your mortgage rate. Once rates do drop, more buyers will rush back in, driving up competition and home prices again. If you wait too long, you could be jumping back into a market where you're competing against multiple offers again. If this video helped you, make sure you hit the like and subscribe button and turn on notifications so you don't miss future updates. I regularly am going to be breaking down real estate trends, home buying strategies, and market insights to help you make the best possible decision. And if you're ready to start your home buying journey or just want to ask me some questions, reach out. I'd love to help. Stay classy.